All right, welcome back to You Heard It From a CFP. My name is Matthew Coyle. Today is December 9th, 2021. Thanks for coming back and watching my video. So today we're going to talk about houses, and we're going to talk about what you can afford, what you should be budgeting, and some other considerations you should take into mind when buying a house, because maybe you've never done this before. Maybe this is the first house you're purchasing by yourself, or maybe you're a first-time home buyer altogether. So let's dive in. All right, so you're considering buying a home. Good for you. I salute you. I'm a homeowner myself. You are considering buying a home, but you're not really sure what to do. Maybe you've never done it before on your own. Maybe someone walked you through the process last time and now you're doing this for the first time on your own, or maybe you're just a first-time home buyer altogether. Who knows? So there's a few terms you're going to have to be aware of and a few things you are going to need to look at in order to make this a good process for you and understand what you're getting into. How much can you afford? What do lenders look for? Et cetera, et cetera. I'm going to keep this fairly general because this can be a very detailed process. If you have further questions, of course, feel free to reach out. But here's some basic things that you want to be aware of. And the first one I'm going to start with are a couple acronyms. There's lots of acronyms in our business, so you might as well get used to it. DTI, which is debt to income ratio, and PITI, which is principal, interest, taxes, and insurance. These are probably the two most important acronyms in the home lending business, and you're going to want to be familiar with what they mean, and you're going to want to be familiar with how they apply to you. So let's dive into each one really quickly. So the first one you're going to want to be familiar with is called DTI, and that's debt to income ratio. In a very simple way, this is your monthly debt obligations in total divided by your monthly gross income. Now, when you approach a lender for a mortgage or to get pre-qualified for a mortgage, they're going to look at your DTI, which is your required credit card payments, car payments, debt payments of any kind, compared to your gross or pre-tax income. When they look at that, they're looking usually for about 36 to 38% or less, combined with a good FICO score, okay, above, say, 700 or at least above 620. You'll get better terms on a mortgage if you have a credit score above 700 and a DTI of less than, let's say, 36 to 38%. If you're above that, you might not get as good a rate or get as good a terms, but that's typically what your lenders look for. So if you're close, if you can look at your credit and then look at all of your debt payments, you have minimum payments on any debt you owe, add that up and divide by your gross monthly income. If that number comes to more than 36 to 38%, let's say, maybe you're in your 40s or it's even in the 50s, maybe you pay a little debt down to get that down, or maybe you retire a little bit of debt early before you go shopping around to get that number down, because your DTI is going to be very, very important. Every lender I've ever seen in my life, and I've been in finance for over 20 years, every lender looks at your DTI without exception and without fail. 36 to 38% is what most lenders will look for when it comes to DTI. So see if you're below that. If not, if you are below that, great. If not, see if you can get down below that with some reasonable transfer of money around, maybe pay off some small debts, whatever. But try and get below 36 to 38% on your DTI. Okay, so let's talk about the second acronym that you're going to be exposed to in this process very quickly, and that's PITI, and that refers to principal, interest, taxes, and insurance. A mortgage payment is actually made up of different components. It's not just the loan you pay. It's actually, for many people, the principal, which is repayment of the note, interest, which is the cost for the loan, taxes, which is taxes on the property, and then insurance, which most lenders, in fact, I think all lenders in today's market, require you to have insurance on the property if they're going to write a mortgage on it. So principal, interest, taxes, and insurance, PITI. Let's focus on the first half of that, which is PI. We'll get to the TI in a second. Principal and interest is the actual loan you took to buy this property after you put your down payment down. So you put your down payment down, you've selected a term, whether it's 10 years, 15 years, 20 years, 30 years. I prefer longer term loans to spread the risk out a little bit and let the bank share some of that risk with me, but that's a different video for a different day. So when you're dealing with principal and interest, most people, it's a general rule of about 25 to 28% of your gross monthly compensation should be devoted to PI. Okay? Now, I like to see it between 20 and 25 if you can get it, especially if you're a higher income earner. Why spend more if you don't have to? But if you can keep it around 25%, that's a good target. That equates roughly to a mortgage that's about 2 to 2.5 times your annual compensation, which is fairly reasonable in most markets. Now, obviously, if you're in a market like San Francisco, New York, or other big cities, this will be a little bit different because at the extreme ends of the scale, things can get a little weird. But for most people, 25% of your gross monthly income should be devoted to PI. Okay, now let's deal with TI next. All right, let's talk about TI, taxes and insurance. There is not a lender in this country that will give you a loan if you don't pay the taxes on your property and you don't agree to insure the property. So by law, you have to pay the taxes on your property and you have to pay the insurance. We'll start with the taxes and kind of talk about that for a second. Taxes on average around the country, and again, at the extremes, it can get a little different, but most people on average will pay a property tax equal to about 1 to maybe 1.25% of the value of their property annually. So if you have a $300,000 property, let's say, in the eyes of the state you live in, then you'd be responsible for $3,000 per year on property taxes for owning that property. Now, you can include that in your mortgage payment. The mortgage company will work with an escrow company that will most likely allow you to just have that deducted from your checking account every month, or as you make your payment, it'll go. Or you can do what I do, which is pay your taxes separately. I just like to know my taxes are being paid by me. I have full control of it, and I write a check to our local county, and that's that. And they cash that, and we're good. So I choose to pay my taxes separately. You don't have to do that. You can have it wrapped up in your with the other parts of your mortgage payment. So that's taxes. And again, it can differ around the country, but roughly the average around the country is going to be about 1 to 1.5% of the value of the property is going to be owed in property taxes during that year. So that's taxes. Let's talk about insurance for a second. You will be responsible to pay insurance. I got the average data here on homeowners insurance, and again, this can differ a little bit, but according to bankrate.com, which keeps pretty good data on this, your percent of median household income that you're going to spend on homeowners insurance is going to be somewhere between 1.5% to 3% of your gross income per month spent on home insurance. Now, again, that's going to be different around the country. In my home state of Minnesota, it appears to be about 2.2%. And again, if you're a higher income earner or a lower income earner, that's going to, it's going to change the number for you. But roughly the median, half above, half below, in a state like Minnesota is going to be about 2.2% of your income spent, gross income spent, on insuring your home, whether you pay it separately to your insurance company or whether you wrap it up with your mortgage payment. I choose to pay my insurance separately, directly to my insurance company, State Farm, but you don't have to do that. You can certainly have it wrapped up in your mortgage payment as well. So you can bank on roughly 1.5% to about 3%, maybe a little higher, maybe 3.5% in total, but that's rare, of your gross monthly compensation will go to the cost of insuring that property, according to some pretty good sources as of December of this year. So that's PITI, principal, interest, taxes, and insurance, and you can have them all wrapped up together in one payment, or you can pay them separately like I do. If you have questions on that, feel free to reach out. All right, some other considerations. If you are ex-military, if you served in the U.S. military, you should check out Veterans Administration, the VA loan program. There are VA loans out there that are, I'm not a member of the former military member myself, but I have clients that have been, and I know people who've gone through the VA for loans, so you might want to check that out and price that as well. What I would also do is I would get a pre-approval letter. Go to a bank, find one that you can work with that is willing to give you a pre-approval letter so you know what you're going into as far as what kind of home you can afford. Again, the numbers I stated previously should act as a pretty good guide with regard to TI and PITI, but get a pre-approval letter because you will need that, especially in the good real estate market, because it is competitive and you don't want to miss out on a home just waiting to get approval for a loan. So walk in there prepared and know what your numbers are, and that's probably some good advice there as well. The other thing I would point out too is make the most of inspections, especially if you're a new homeowner. Inspections are critical. Make sure you don't overlook the inspection. It's willing to pay a $300 inspection fee to avoid a $300,000 mistake. So make sure you take full advantage of home inspections. Make sure you go visit homes regularly, see where you want to go, and check out some neighborhoods, especially if you haven't done it before, because there are the little things that you might not know in a listing that really pop up when you show up at the door. So that's it for the basics. There's a lot to a mortgage. If you have questions, feel free to reach out. There's information at the end of this video. So if you don't stretch yourself too thin and you come to the table knowing what you can afford and you know your ratios and you know your budget, you should be fine. Even in a competitive market, you should find a decent place to land. And my best of luck to you. Reach out if you have any questions, and thanks again for watching. Take care.